Hey everyone, in today's video, we're going to be talking about 5 stocks that I've recently bought and one stock that I've actually recently sold in my $262,000 Wealthsimple stock portfolio. If you like this kind of content, be sure to give the video a big thumbs up. It helps a ton with the channel, and consider subscribing as well for more content like this. Before getting into the stocks themselves, we're just going to do a quick review of how the portfolio has been doing over the last few months. You can see here the Canadian side in the last 3 months is still up 11%. Has gotten even better in recent time periods, up another percent in the last few months. Going over to the US side, in the last month we're up 3%, and in the last 3 months up 13%. So across the portfolio, we're up double digits just in the last 3 months. Market's been on a really nice run, especially on some of these interest rate sensitive stocks that have gotten pummeled recently with interest rates going up. It's kind of corrected back a bit, which has helped my portfolio a lot, given that I own lots of REITs, lots of banks, stuff like that in here since they're dividend payers. But I'm going to start off by talking about the one stock that I've actually sold in this portfolio in the last month here. That stock was Jameson. So I'm just going to bring up the ticker here quickly. But the reason I sold Jameson is it just kind of ran a good amount from where I bought it. Looking at the last 1 year chart, my average price on Jameson was $23, $24, and I got out of it just over $31 a share. I started buying Jameson in the kind of mid 20s here, 25, 26, averaged down a bit when it crashed to the low 20s. And then out of nowhere, they had a good earnings report. In addition to that, with rates outlook going down, the overall market kind of just surged. And it went from $22 to $30. So it was a good 30-35% jump in the matter of 60 days or so. I got out at about a 26-27% gain. And the problem was I didn't really get the chance to build out a huge position in Jameson. Only had 125 shares. So that is about $4,000, give or take, from the point that I sold it at, which was a pretty small position. I don't own it in any other accounts or portfolio, so that was my total position of Jameson across my accounts, which just wasn't large enough for me to stick with. And the price got to a point where I thought it was returning closer to fair value, and it wasn't an attractive enough price for me to warrant putting more and more money into it after it jumped that 30-35%. But I still think it's a decent company. Looking here, 2.25% starting dividend yield at these levels here. If we look at some more of their company information here, they're growing really nicely. Obviously, mostly a Canadian company, but they've recently expanded into the US with the acquisition of Theory. They just bought out their wholesaler in China, so they're going to naturally have pretty nice revenue growth there as they realize the whole value chain. And internationally, like exporting to European countries and stuff like that is kind of the fourth priority on their business. So not a huge profit or revenue driver, but it's just one area that they keep in line to achieve scale and lower overall cost of goods per unit. In terms of their overall outlook for 23, going to do almost 700 million in sales. This is a bit of misleading growth because it includes the acquisition of Theory, which is 150 million of this 240 million. So keep that in mind. You can see here the 150 million from Theory. But decent growth across the board. Canada is much more developed, 3 to 4% growth they're having there. China, 30% organically, but 75% because they're going to get their wholesalers share as well. Internationally, not a huge focus, super small, under 5% of the company, but expecting high single-digit growth. And then from a EPS basis, going to do about 0 to 5% growth, $1.60 a share. So if I took their $1.60 a share, looked at their current share price here, they're trading at about 20 times. I don't think that's overvalued, but it's much more fairly valued than when I was buying it 15, 16 times earnings. So this is a case of just was slowly building the position, continued to dollar cost average in, but because of the jump, didn't get the chance to build it out to the size I wanted. And because of that, nothing wrong with just taking a 25% gain when a position didn't get large enough to be meaningful in the grand scheme of things to you. So that was my sell that I made a couple of weeks ago in the market. Going over into my buys, and lots of my buys were actually from that proceed from selling that $4,000 of Jameson stock. At the beginning of the year, I obviously try to fill up my TFSA first, then try to max out or manage my RRSP in the first 60 days of the year to maximize my tax refund over the years. So it's a bit light on putting new money into this account. So lots of these buys were actually made from that sale of Jameson plus some new dividends flowing through into the account. The first stock I bought a bit more of was Fortis. Fortis has kind of stagnated over the last year here, actually down 2% over the last year, but continues to be a really nice dividend growth stock. This one is trading at a 4.2% dividend yield, and just looking at the company over a longer period of time here, they've actually increased their dividend pretty much every single year for 50 straight years. And over the last 5 years, they've increased the dividend 6% a year, which is a really nice rate of growth for a company with a dividend yield over 4% already. So I like that starting yield over 4%. I like the history of the increases and the pace that they're increasing it at. And they just announced recently that they increased the dividend again for dividend yield to 4.3%. I think it was a 4 or 5% dividend increase this time around. So slightly less than the 6% that sometimes they do, but in line with their guidance of 4 to 6% as well, which really helps drive confidence that they'll continue increasing it up until 2028. And realistically, as soon as they get close to 2028, they'll publish something on their next 5 years expectations for dividend growth. So this is a great dividend growing company. I think when I first bought into the company, they were paying a dividend in the 30s in terms of cents per share, and now they're at about 60. So it's almost doubled since I initially bought into this company a number of years ago. And I think it'll double from here over the medium term as well, and kind of continue that compounding effect. So haven't bought shares of Fortis for a while. They have been stagnant for a bit, so I thought it was a good opportunity to, you know what, take some of those proceeds from Jameson, put it into Fortis, feel pretty safe that I'll be getting that 4+% dividend yield and it growing into the future. Not the most excited stock, it's a regulated utility, but really reliable income source. The next stock I bought was TD Bank. TD Bank here had a bit of a rough month. If I go back, was down when I bought it about 6% on the month. It was right around $80. I don't think I got it under 80. And TD Bank at these levels, yielding, I think after their recent dividend increase, yielding 5% at the point that I bought it in. And I just thought it was a good opportunity. TD Bank is a long-term hold for me, one of my biggest positions if I look across all of my accounts, and haven't been buying too much of it in the last year or so. With that being said, it's had a pretty tough year, down 10% on the year, was down 5% on the month. So I said, let's just nibble a bit more into TD. I think I just bought 5 shares if it went from 105 to 110 shares. My cost basis in this account is still over $85, so I was averaging down in this particular account and locking in that 5% dividend yield. And overall on the banks, I really like the banks, specifically the Canadian banks. They're trading at about 10 times earnings. They have really good track records of dividend growth, EPS growth, and they essentially work in an oligopoly where I have a very hard time seeing a situation, a reasonable situation, that these banks come under any significant long-term financial turmoil. Looking at their EPS estimates here, expected to do about $8 this year. That came down from about $8.40-50 based off some comments from the CEO on it being tough to hit 2024 earnings expectations of growth. But then in 25, expecting $8.50. So let's just call it about 10 times earnings at these levels. They pay 5% in a dividend. They keep the other 5% to reinvest and grow their business for the future. And I think they announced a pretty nice share buyback program. So even as the shares start going down, with the long-term position that I've built out in TD, I don't even really mind that in the short term. It means on the buyback, I'm getting more ownership of the company from them buying back more shares than they'd otherwise be able to do if the stock remains higher. I obviously don't want the stock to crash or any fundamental issues, but 5% down in a month for no real apparent reason and stuff like that, I really don't mind it in the short term on this stock here. The third stock I bought was actually an ETF. I added a bit more ZDI, which is an international dividend ETF. This one's actually done really well, up 5% in the last year. Overall, I'm up 14%, and that's after averaging up in this a bit. I think I bought 20 or 30 more shares in the last few weeks. Pays a starting dividend yield of about 4.3%. So nice yield. It gets paid out monthly. In terms of what this ETF holds, it's primarily a European ETF. Here's the fact sheet here. Just going into the results, to deliver about a 6%, 7% return over the year, so not too bad. Geographically, it has its largest equity exposure to Japan. That's a bit misleading because after Japan, it's pretty much all European, other than a couple percent in Australia. So I'd say this is about 70 to 80% European and Europe ETF, with France, Switzerland, UK, Germany. I think it has some Italy, some Spain. You see Denmark, etc. in there, and then maybe 20%, 25% Asia with, or Pacific region with, couple percent Hong Kong, couple percent Australia, and then 18% Japan up there. And then in terms of the sectors, has a lot of healthcare, has a lot of consumer staples, consumer discretionary, which is a nice little mix from someone who primarily owns Canadian stocks, because I tend to be over indexed in banks, the Canadian economy. So my Canada ETFs are over indexed in energy and those kinds of things. So it gives me exposure to new sectors, new geographies, and just really looking for that diversification and reliable monthly income that this ETF provides. So the ETFs run up a bit as kind of the European economy has rebounded from the war. If I was to look over the last 5 years, you can see the crash here in 2022 when it was kind of that energy crisis, and it's bounced back from $16 a share all the way up to $22 a share. So I've been pretty careful with how much I've been adding, but just because the stocks run up in the short term, I still don't want to get away with my long-term diversification goals geographically of having more and more exposure, or at least keeping up my exposure in the European markets, because I don't own many European first stocks in any of my portfolios that I have. Going into the fourth stock, going to the US side, the fourth stock that I added was Visa. And Visa has been one that I think for the last few years I've been trying to add more and more Visa shares. Love the business model, love how fast they've been able to grow and sustainably over long periods of time. Love how much capital they return to shareholders, how low capex their business is, so they're just a cash flow machine. And I think they have lots of tailwinds on people going from cash to card in emerging markets. In addition to that, I just think they have essentially a tool booth on the global economy. As more people spend money and inflation goes up, they pretty much just have a royalty on that global economy, which I think is a really powerful business model and a great moat to have, as they're pretty much in a duopoly with MasterCard in this space, with some exceptions, obviously. But the pain point has been the stock has performed really well. Looking at the last 5 years, up 100%. Last year here, where I was trying to average in the beginning of 2023, I made a video on how I wanted this to be my #1 stock of the year, but it went up 21%. So we're at $270. I think I bought in at about $266 this month. And it's one that I want to go in heavier, but the valuation is holding me back a bit. So I just bought, I think, 2 shares this month added to the position. And here at $271, I'm just kind of taking a break. I've done pretty well in this account and the other account that I've been buying Visa shares in. It pays me a small dividend, very small. They increase it every year, a good double-digit chunk though. And they just continue to buy back shares. So I'm just going to pause on Visa here. I still actually like it at current valuation. I'll take a look at their valuation in a second. But longer term, there's lots of other opportunities in my portfolio too. And maybe I just give Visa an opportunity to soften up or catch up to their valuation a bit, maybe pull back a bit. In the last month alone, up 5%. In the last 3 months, up 17%. So they've outperformed the market pretty well. Hopefully there's a bit of a pullback or something, and I can make this position much larger like I want. looking at some of their business results here, you can see just Q4 continuing to grow revenues double digits, 11%, income 19%. And then since they buy back shares pretty frequently, their EPS was up 21%. So really strong double-digit growth. That's very consistent year over year over year. They've been growing at paces like that. Looking at how profitable and much of a cash cow this business model is, year to date, or in the year, I guess, because it's Q4, they made $21 billion of net cash proceeds from operations. They had $1 billion in CapEx. So they had under 5% CapEx out of their net cash flow. So their free cash flow is $19.7 billion out of their $20.8 billion. So really productive business model that they have. And then what do they do with that $19.7 billion? They pay out $3.7 billion in dividends. That was at 0.7%, which is super small, but I guess it's nice to get some kind of capital return from your Visa position. But then they just buy back tons of shares, $12.5 billion of share buyback. And even at these levels, this is $16 billion. So they kept about $4 billion to reinvest in future growth, even though they really have the model set up and just waiting for tailwinds across people going cash to card and the global economy growing. They still have $4 billion more of ammo to proactively invest in other business growth opportunities as well on an annual basis. They also have a really good balance sheet. So definitely a kind of top tier company here. In terms of their EPS, going to do about $10 this year. So trading 27 times. Like I said, I don't think 27 times for a company of this quality, growing double-digit earnings, double-digit revenue, lots of secular tailwinds, pretty much in a duopoly, is a crazy valuation given the track record of Visa. Looking at 2025, it's at 11, so trading 25 times 2025. So still one that I'm really interested in. I just have a hard time buying stocks when they're up 20% on a quarter. That's why I only nibble into this one a couple, but it's one that, while I'm putting it aside in terms of immediate buys, I'm hoping that I get a better opportunity, maybe a little bit of a pullback, and I can, add a bit more aggressively, since I've just been consistently nibbling on this one, very small, like very little by little, 2 shares here, 1 share here over the last year, 18 months. Okay, going into the last stock that I bought in my portfolio this month, it is Realty Income. So Realty Income, I really just wanted to get up to 200 shares in this account. I've also been buying Realty Income, or starting to buy it in my RSP, because I don't have withholding taxes that chew up earnings in that account. You can see here Realty Income has still been down 15% on the year. It has bounced back from when it was in the high 40s to the high 50s. And then I got it a bit on this pullback. I think it was around $58, so it's much cheaper now, $56. Could have got 3-4% lower. But overall, I just bought 3 or 4 shares because I wanted to get to that 200 share goal in this account. I don't think I'll keep buying it in this account. It's just tax inefficient given how big the yield is. And I have other opportunities to buy it with cash I'm generating in my RSP, where it's a bit more advantageous from a tax structure standpoint. In addition to that, 11,000 US dollars is a pretty good size position for a REIT on my US side. So I'm happy with the size of the portfolio. It's spitting out a good chunk of dividends on a monthly basis for me to reinvest in other stocks in my US portfolio. So I'm pleased with where this position is. The stock goes lower from here. They do about $4 of funds from operations. So trading at about 14 times, give or take right now. If it goes down to 13, 12 times, happy to add more in my RSP, depending on what the relative value of Canadian REITs are. If something like RioCan or CapREIT go to an even lower FFO multiple, maybe I just add to that, but it's all relative. This is one that I do like the diversification of it. Again, though, I keep citing diversification. That's one of the big themes for me to grow this year and last year as well, as I have primarily a Canadian portfolio here, trying to make it more North American with stocks like Realty Income, and I'm trying to sprinkle in international as much as possible, even though they don't tend to perform as well. I just value the diversification over max peak returns, just in case things happen in the world. It makes me sleep at night a bit better. And Realty Income does have a percentage of their income, probably just 9–10%, coming from the UK and some European countries. So I do like that exposure as well that they offer me in the real estate space. So those were the 5 stocks that I've been buying in my portfolio, 2 US stocks, 3 Canadian stocks. And aside from that, just wanted to share that I sold that Jameson position, not because there was anything wrong with the company. I think they're actually set up pretty well, 20 times earnings for a growth company in a wellness space. It's just kind of run up from the 16 times. I didn't get the chance to build it into a big position. So hope you like this kind of content. If you stayed till the end of the video, thanks so much. Let me know in the comments. We don't get a ton of people staying till the end because my videos tend to be pretty long. Give this video a big thumbs up. Really does help with the YouTube algorithm, and I'll see you guys in the next one. Thank you.